The traders that are having a really hard time are buying up here on the breakout. They're feeling the FOMO of missing out right here and right here. And we want to buy below the level of the neutral position because that's where the deal is. Because right now this tells me that 30-minute guys pushed the price up, saw that it was breaking this high, saw no one else was coming in or the price wasn't continuing to go up from their perspective, and they're like, okay, never mind, boom, collapse. But for a 5-minute trader, this will clean you out. Like this will just leave you like, I don't even know what's going on here, and I'm down 70%. Okay, what should be the ideology for trading when the daily's up and the weekly is down? When the weekly is short and the daily's long, those timeframes are somewhat more closely related. When you get divergence on timeframes that are more closely related, meaning they're closer in time, then you're getting a mixture of confusion on those timeframes. And what that typically ends up being is big range whippy activity, which is basically what we got going on right now. Like right here, this stuff is big accumulation tactics, big moves from banks, stuff like that is pushing the market around, and there's no follow through. You'll notice that we're getting all kinds of moves where we get these big moves and then they retrace, or you get something like this and it reverses. All this, when you're getting, 50, 60 pip whips in a few hours, you're not going to get 60 pips of movement, 60, 70 pips of movement without bigger timeframes being involved. That's where those guys push that around. But the fact that there's no follow through in a lot of this and it keeps backing up is because ultimately they're making moves, but there's still confusion. The confusion is what's causing the follow through to not stick. And also too, you look at the daily, the weekly, there's confusion here. And really, I think it comes down to, if we jump down to the monthly, is a monthly's trying to figure out, am I going to retrace off of this level right here, or am I going to keep moving down? That's because there's confusion all the way up to the monthly chart. The daily and weekly are ranging out. Because remember, the daily can't follow through until it gets backed up by the weekly and the monthly. Really, the monthly. It's not going to continue to trend. So you're going to get stuff like this. You're going to get these big whips like this that are going to happen. And you're going to be like, oh, it's finally moving. And then it just gets sucked right back up. And it's usually just enough for you to jump in and get sucked back up. So that, anyway, to answer that question, that's what's going on when you get a daily and a weekly that are divergent with each other. Then you're going to have whippy big range action. That's typically why I always recommend wait till the daily is trending with the weekly, because a lot of that will smooth out. Particularly if the daily and the weekly and the monthly are all trending in the same direction, that's where you're going to get overall smoother movement. It's not going to always be like that it lines up, but you really, like, if you're trading the 30-minute into the daily, you got to think like your big moves are going to happen really over the course of like a few days. So it would be better to have those few days fall in alignment with the weekly, because the weekly is already moving that direction. So we're using the weekly to stabilize the daily. Another thing I want to comment on, this is just, it kind of reminds me of that. This is what I want you guys to be aware of when you're trading the 5 into the 4 hour and stuff like that. When I talk about, if you're trading lower time frames, you guys are able to just kind of, you could do well for a long time, and you're basically, you're just trading the trend. It's all working out good. You're chipping away, pulling 5, 10, 15 pip trades. And then the market moves so wildly that you get thrown out of a trade. And I haven't looked at the news. I'm assuming that some of this could have been news. But in markets like this is where it gets really sketchy. So you're trying to follow the 4 hour trend right here, and you're doing everything you can. And then it gets this big deviation through the ATS trend and then wipes that back. That stuff, like this, this is there was nothing wrong trading this right here where you had fair market value. It came up, it started trading below right here. Like, oh, I'm getting good positioning. And then wham, something like that can happen. And then you get, these big moves. And then you think, okay, it's setting up short. And then boom, you get another big move against you. And this is what I talk about a lot of times, is that you guys are trading lower timeframes and you're kind of chipping away at these smaller trades. And then one crazy day just like completely demolishes all your gains. And it's because on the smaller time frames, it's all fair and well when you're just getting these nice little waves and these nice movement. But when you get the higher time frames kick in and they make a move, it's kind of like a miniature black swan event. Like this right here, it's like this was all fun and games. You're like, I'm right under value. I'm going to control my risk. And then you get something that smashes through like this. And then you're like, whoa, like this is like so out of character compared to the average waves that I've been dealing with. So this is the kind of stuff that happens so fast that it can really spin you out. And that's what I wanted to talk about on this, that it reminded me, and I wanted to talk about this in general, but that's where most people get messed up. You can scalp all fine and good, but when the high time frames hit, and it hits a level where they're interested in, what was ranging 10, 15, 20, 30 pips now all of a sudden has a 70 pip range, and you're trying to navigate that all of a sudden, and you're used to having 5, 10 pip stop losses. In a situation like this, you can hit your 10 pip stop loss over and over and over and over again, and you're just sitting there trying to figure out like what the heck's happening. But versus when you're trading only the higher time frames, yeah, it's still pretty wild, but you're naturally going to be aligned with these movements. In fact, a lot of these wild moves end up becoming entry opportunities a lot of times for the higher time frames, because the higher time frames are going to move 60, 70, 100 pips over the course of days, or they can do it in a day whip move, but it really doesn't significantly affect how you're going to enter that market. It's just kind of part of the volatility that you deal with all the time on those higher time frames. But for a 5-minute trader, this will clean you out. Like this will just leave you like, I don't even know what's going on here, and I'm down 70%, you know? So that's what I thought this was a good example to show you guys. If you feel like, oh, I'm doing good, but then all of a sudden you're like, man, a couple of days I get wiped out. It's because those higher time frames, they move fast, and they're fierce and they're ferocious. And if you don't aren't super strict, and this is where I talk about like playing this like a high level athlete. Like if you're not insanely strict to your directional bias and insanely strict to sticking your stop loss, and you're strict to waiting things out when they get crazy whippy, and don't try to jump in and trade on it, this could really derail you. And that's where I find a lot of people, they can do well right up until they get some curveballs thrown at them, and then they don't know what to do, and it could be devastating. So take that to heart and just understand what I'm saying there. This kind of stuff is the problem with scalping and adapting to it quick enough. It's not the easy moves, it's this stuff. You start getting the daily, weekly. This is where people are making decisions. The banks are making decisions for their trade placement, either unwinding trades or starting new trades that they're going to hold over the course of weeks or months when you're looking at daily and weekly levels. So, that's why you're getting this crazy whippy activity. That's why it's not great for scalping. And it's treacherous. So part of your job as a trader is understanding this is the weather. It's stormy out right now. It's stormy. It'll smooth out. The sun will come out when the daily and the weekly start aligning and start telling the same story again. That's where things will be much more predictable. That's where expansion lines and framework will start holding a little more predictably, because you're not getting higher time frame players and banks throwing bombs of liquidity and making big moves all of a sudden when it's ranging 20 pips and boom, it's like, what the heck just happened? So that's what happens when you get confusion on the daily and the weekly. They're making moves, they're trying to figure it out, try to figure out how they're going to make money over the next few months. And that's what we're experiencing right now. What are the clues to finding out when the price is reversing versus a short pullback? That's really going to have a lot to do with how the price is holding on your lower time frame. That's where you're going to get the clues first, but there's clues all over the place. It really comes down to rejections of levels of framework. When you're dealing with a trend line, or you're dealing with an expansion line, you're going to be dealing with levels that are relevant to where you are. Like we look at right now, this is obviously the most relevant level. We could look at that these are clues to taking the market long. Right now, everything is showing that it wants to go long. The weekly is still short, but it could easily pull around. I think there's a good chance we're starting to break out on the daily box here. So, yeah, daily's long. Things are showing long. So what we would look for as an example if the daily starts to go long and we're trading, and then we get, let's say we get a box up in this neighborhood up here, and we expand out of that box, it trades short, and then it starts trading up to the expansion line, and it's acting, that line's acting as a ceiling to price. It doesn't really want to get through. Then basically what that means is that the daily could be rotating. So we can see clues on the lower time frame happening before it starts to happen on the daily. And that really comes down to what needs to happen with the expansion phase. Like the only way this is going to continue to trade up and establish a box up here, being the 30-minute, is if the hour, the 4-hour, and the daily come in and sustain price. So this is also showing you clues. You've had 1, 2, and almost 3 chances to break this high right now, where it's come back to value, that the daily hasn't jumped in and sustained price. So what that tells me is that the daily's coming in, and it might come around later, right? We're still trading above fair market value. So it's not like it's holding as a floor, not a ceiling. But the fact that we keep breaking out and it keeps collapsing back to fair market value is telling me that the higher time frames aren't interested yet. They're not coming in, because if they did come in, you would get somebody at the top of this 30-minute candle that has a trading plan that they're going to hold their position for 4 hours, a day, multiple days, maybe a week. I need that person to come in and buy the market above the 30-minute guy. Because right now this tells me that 30-minute guys pushed the price up, saw that it was breaking this high, saw no one else was coming in, or the price wasn't continuing to go up from their perspective, and they're like, okay, never mind, boom, collapse. We know who's active in the market when we see an expansion not take hold and keep trending. We know that, okay, this market is limited to 30-minute players right here. Daily players could start to grab this and it'll start going. That could happen, but we don't know that. And that's why it always goes back to the basic strategy. When you're trading headed up and we're looking at our directional bias alongside, we want to get positioned under fair market value, because we're expecting we're going to get collapses back to value. The traders that are having a really hard time are buying up here on the breakout. They're feeling the FOMO of missing out right here and right here. They're feeling that. And we want to buy below the level of the neutral position, because that's where the deal is. That's where the discounted inventory is, right? So we don't know when the daily's going to come in. I don't know when the 4 hours is going to come in. I have no idea. But what we know is that we can get safely positioned based off of a fair price, and knowing we're paying below that fair price in expectation that we're going to come out, and hopefully, no one knows for sure, but hopefully the 4 hour, the daily, these guys will jump on and sustain the trend phase of the market to a higher price. We don't know. So all we can do is position ourselves to trade safely. That's the best we could do.